They told you gold was the ultimate safe haven, the one asset, the one that goes up when everything else falls apart. War breaks out, gold goes up. Stock market crashes, gold goes up. Dollar gets weaker, gold goes up. Inflation spikes, gold goes up. That's the story. That's been the story for decades. You've heard it in textbooks, in retirement planning seminars, from your parents, from every financial advisor who has ever slid a brochure across a desk at you. Gold is the safe haven. Gold is the hedge. Gold is your protection when the world goes sideways. That story has been told so many times, repeated so confidently, that it became financial gospel. Questioning it felt like questioning gravity. So let me ask you something. Today is March 23, 2026. Right now, as you watch this video, the United States is engaged in an active military conflict with Iran. The Strait of Hormuz, the choke point through which roughly 20% of the world's oil supply flows, has been closed for weeks. Oil is up 75% this year. Brent crude is above $130 a barrel. Inflation fears are surging. Markets are rattled. The geopolitical situation is as dangerous as it has been in a generation. Now tell me, what is gold doing right now? Gold is down over 10% this week. Gold fell below $4,150 today, its lowest level since December 2025, before the big rally. From its all-time high just a few weeks ago at $5,589, gold has shed more than $1,400 per ounce, the worst weekly drop in years. More than $2 trillion in market value erased. Active war, closed oil choke point, inflation fears, global panic. And gold is cratering. Let that sink in for a moment. They told you gold was a safe haven. They lied. Or, more accurately, they oversimplified. And today, we're going to show you exactly why gold is doing the opposite of what it's supposed to do, what three forces combine to create this paradox, and what it means for your portfolio going forward. Because understanding this isn't just about gold, it's about understanding how markets actually work versus how they're supposed to work on paper. Welcome to Bull Finance. We don't sugarcoat. Let's get into it. Before we can explain why gold is crashing, we need to understand what gold is actually supposed to do. Because a lot of people think they know, but the real answer is more nuanced than most financial media lets on. Gold has four main jobs in a traditional portfolio. Job 1, inflation hedge. When the purchasing power of paper money erodes when a dollar buys less than it used to, gold is supposed to hold its value. The logic is simple. You can't print more gold. Governments can print unlimited dollars, so as more dollars flood into the system and each dollar becomes worth less, the price of gold in dollars rises to compensate. This is gold's oldest and most well-documented role. Job 2, currency debasement hedge. Related to inflation but distinct. When governments actively devalue their currency through money printing, near-zero interest rates, or deliberate weakening, gold acts as a store of value outside that fiat system. This is why central banks hold gold in their reserves. It's the only asset that no government can inflate away. Job 3, safe haven in geopolitical crises. When wars start, when political systems destabilize, when the normal financial order is threatened, investors historically flee to gold because it's been a store of value for 5,000 years. Unlike stocks or bonds, gold has no counterparty risk. It doesn't depend on a company staying solvent or a government honoring its debt. It's just metal, valuable metal. And that has meant something through every war, every collapse, every empire that has come and gone. Job 4, portfolio diversification. Gold generally doesn't move in the same direction as stocks and bonds. When portfolios need ballast, when volatility is high and correlations between assets spike, gold is supposed to be the one thing not falling with everything else. Those are the four jobs, and in a scenario involving an active war, spiking oil prices, inflation fears, and global market uncertainty, gold should theoretically be performing all four of those jobs simultaneously. Instead, it's down 10% on the week. Why? Three reasons, and they build on each other. Let's take them one at a time. Reason number 1, the dollar paradox. To understand this, you need to understand what happens to money when a global crisis hits. Every investor on Earth, every pension fund, every hedge fund, every central bank, every individual with a brokerage account wakes up in the morning of a major crisis and asks the same question: where is the safest place to park my money right now? For 5,000 years, a significant portion of that money went into gold. But something changed after World War II. In 1944, at the Bretton Woods Conference, the United States dollar became the world's reserve currency. Every other currency on Earth was pegged to the dollar.
Global trade was denominated in dollars. Oil was priced in dollars. And ever since, when the world gets scared, truly scared, the instinctive flight isn't just to gold anymore, it's to the dollar. And here's the thing. The dollar and gold are rivals. They compete for the same investor dollars, if you'll excuse the circular phrasing. When confidence in paper money is low, gold wins. When confidence in the dollar specifically is high, the dollar wins. And when the dollar wins, when everyone is piling into dollar-denominated assets, the price of gold in dollars goes down. So what happened when the US-Iran conflict escalated and the Strait of Hormuz closed? The world panicked, and the world's instinct in 2026, even in a crisis involving the United States, is still to run to dollars, not away from them. Because as messy as American politics are, the dollar is still the deepest, most liquid, most trusted currency on Earth. There's no alternative of comparable scale. The euro has problems, the yuan is not freely convertible, the yen has its own issues, Bitcoin is too volatile. Gold is the one true competitor, but in a short-term panic, liquidity wins, and dollars are more liquid than gold. Global investors poured money into U.S. Treasury bonds. The dollar index, which measures the dollar against a basket of other currencies, surged, and as the dollar strengthened, gold's price in dollars fell. Not because gold became less valuable in absolute terms, but because the dollar strengthened, which means each dollar buys more gold than it did before. Think of it this way. Imagine gold costs $5,000 per ounce when the dollar index is at 100. Now the dollar gets 10% stronger, the index goes to 110. That same ounce of gold in terms of its value in other currencies hasn't really changed, but now you only need $4,500 to buy it in dollars. From a dollar price perspective, gold went down. Not because anyone hated gold, but because the dollar got stronger. Gold used to be the panic button, the single safe haven that everyone agreed on. In 2026, the dollar has stolen that job. And in a crisis involving America specifically, where the US military is the one doing the fighting, investors trust American dollars more, not less. Gold is the backup generator, useful when the main power grid fails completely. But as long as the dollar is still running, as long as people still trust it, the backup generator stays in the garage. That's reason one. Reason two, the Trump ultimatum and the market mechanism nobody is explaining. On Saturday, President Trump issued a direct ultimatum to Iran to reopen the Strait of Hormuz within 48 hours or face strikes on Iranian power plants and infrastructure. Iran responded by threatening to retaliate against neighboring countries if Trump acted on his threat. Now, if you just read that paragraph, your intuition probably says this should make gold go up. More war risk, more fear, more safe haven demand. And if this were 1985, you'd probably be right. But here's what actually happens in modern markets when a countdown clock appears. Professional money managers, the people who move markets, don't react to geopolitical news the way retail investors do. They don't say, "I'm scared, let me buy gold." They say, "My risk models just changed. I need to rebalance my entire portfolio immediately, and I need to raise cash to do it." When a major institution, a pension fund, a sovereign wealth fund, a large hedge fund, decides it needs to reduce risk exposure, it doesn't sell stocks that are hard to sell quickly. It doesn't sell its real estate holdings. It sells what it can sell, fast, at scale. Gold futures, gold ETFs, the most liquid gold instruments in the world. This is called forced selling or de-risking, and it has nothing to do with how the institution actually feels about gold as a long-term asset. It's the ATM. It's the place they go when they need cash in a hurry. And here's where it gets really perverse. When you have a 48-hour countdown clock on a potential military escalation, Institutions don't wait to see what happens. They de-risk before the deadline. Because if you wait for the bomb to drop literally and then try to sell your gold, everyone else is doing the same thing and the price has already moved against you. So you get this feedback loop. Trump issues ultimatum. Large institutions start selling gold to raise cash and reduce risk. The price starts to fall. Other investors see the price falling and panic. If gold is falling in a crisis, something must be really wrong. They sell too. Algorithmic trading systems detect the downward momentum and pile on the short side. Prices fall further. More margin calls get triggered. More forced selling. That's not a reflection of gold's fundamental value. That's a liquidity cascade. And here's the specific data point that makes this clear.
When the Strait of Hormuz closure first hit the headlines, gold actually spiked from around $5,296 to $5,423 in a matter of hours. That was the initial "this is scary" buy gold reaction. Then the institutional de-risking kicked in, and gold reversed all of that gain and then collapsed another 6% on top of it in a single session. By the time trading closed, gold had gone from $5,423 to below $5,000. The news that should have boosted gold triggered the crash. Why? Because the news was so dramatic, so definitive, that it forced portfolio repositioning at an industrial scale, and gold paid the price. This is the part of the gold story that financial advisors don't tell you. In the short term, in the days and weeks following a crisis, gold can and does fall because it's too liquid for its own good. It gets liquidated to fund the panic. The longer-term story may be very different, but in the moment gold is most needed, it can become the victim of its own usefulness. That's reason 2.
Reason 3. And this is the one that poses the most serious long-term structural threat to gold in 2026. The Federal Reserve's interest rate trap. Here's a fundamental truth about gold that most people don't fully internalize. Gold is a zero-yield asset. It pays no interest, no dividends, no coupon. If you own 1 ounce of gold today, in 12 months you will own exactly 1 ounce of gold, nothing more. That's fine, even advantageous in certain rate environments. Specifically, it works when interest rates are very low or near zero. When your alternatives, savings accounts, treasury bonds, money market funds, also pay you almost nothing, gold's zero yield isn't a disadvantage. You're not missing much. And in exchange for that zero yield, you get something those other assets don't offer, a store of value that governments can't print more of. This is exactly why gold went from $2,600 per ounce in early 2025 to over $5,000 by early 2026. The rate environment was supportive. Markets expected the Fed to cut rates through 2026. Lower rates mean lower yields on bonds, which means gold's zero return becomes relatively more attractive. Lower rates also tend to weaken the dollar, which, as we covered, tends to strengthen gold. Everything was aligned. And then oil happened. The Strait of Hormuz closure sent oil prices surging. Brent crude is now above $130. WTI crude is at multi-year highs. And oil doesn't just affect your gas prices. Oil is embedded in the price of almost everything in a modern economy: manufacturing, shipping, food production, retail logistics. When oil spikes this dramatically, inflation follows. It's not a theory, it's physics. So the market is now looking at this situation and doing some very uncomfortable math. If oil stays elevated, and with an active conflict there's no clear reason it comes down soon, then inflation is going to spike significantly in the next 2 to 4 months. And the Federal Reserve's legal mandate is to maintain price stability. Translation: if inflation spikes, the Fed is going to raise interest rates, not cut them, raise them. Higher interest rates mean higher bond yields. A 10-year Treasury that was paying 3.5% might now pay 5%, 5.5%, maybe more. And now gold's zero yield is a serious problem. Why hold something that pays zero when the safest debt instrument in the world, backed by the US government, is paying you 5%? Why take the price risk, the volatility risk, the storage cost of gold when you can lock in 5% risk-free? This is what's called the opportunity cost of holding gold. And as rates rise, that opportunity cost rises with it. At near zero rates, the opportunity cost of gold is near zero. At 5% rates, you're giving up 5% per year to hold gold instead of bonds. At 6% rates, you're giving up 6%. Every percentage point increase in rates is a headwind to gold demand. And here's the cruel irony. The same war that should be pushing investors into gold as a safe haven is, through the oil inflation Fed chain, creating exactly the interest rate environment that is most hostile to gold. War causes oil spike. Oil spike causes inflation fear. Inflation fear causes the Fed to raise rates. Higher rates increase bond yields. Higher bond yields decrease relative demand for gold. Gold falls. That's not a conspiracy. That's not market manipulation. That's just how interconnected modern financial systems work. And it's why understanding macro forces matters infinitely more than reading chart patterns. That's reason 3. There's a fourth factor worth discussing, even if it doesn't fit neatly into the 3 reasons framework, and that's what analysts are calling the paper gold problem. Most people who own gold don't own physical gold. They own an ETF, or gold futures, or shares in a gold mining company. These are all forms of paper gold, financial instruments that track the price of gold without actually requiring you to hold a gold bar in your hand. And paper gold behaves differently from physical gold in a crisis, very differently. When you own physical gold, a coin, a bar, actual metal, nobody can give you a margin call. Nobody can force you to sell at the worst possible moment. You just hold it and wait out the storm. But when you own paper gold, ETFs, futures contracts, you are in the financial system. Your broker can issue a margin call. Your fund can be forced to liquidate. Algorithmic trading systems can detect momentum and amplify moves in either direction. The leverage in the gold futures market is enormous. A small directional move can trigger massive forced selling as leveraged positions get unwound. That's exactly what happened this week. Physical gold demand from stackers, jewelers, institutional buyers of actual bars held relatively steady. The premiums on physical gold above the spot price actually increased because physical buyers knew this was a discount opportunity.
But the paper gold market, the futures market, the ETF market, that's where the selling happened, and the paper gold market is vastly larger in dollar terms than the physical market. So you had a situation where the price of gold, which is determined by the paper futures market, not the physical market, fell dramatically, even as the physical market was quietly saying, these prices are low, we're buying. This is a structural disconnect that every gold investor needs to understand. In the short term, the price is set by paper. In the long term, the physical reality tends to reassert itself. But in the chaos of a crisis week, paper rules. Here is the uncomfortable question that nobody in mainstream financial media is asking loudly enough. If retail investors and leveraged traders are panic selling gold right now, who is buying? Let's talk about central banks. For the past 3 years, central banks around the world have been accumulating gold at a pace not seen since the 1960s. China has been adding to its gold reserves every single month for over 2 years. Russia, India, Turkey, Poland, Saudi Arabia, all building their gold reserves aggressively. The World Gold Council documented that central banks bought over 1,000 tons of gold in both 2023 and 2024, record years. Why are they doing this? Because central banks are not playing a one-week game. They're not managing a quarterly earnings call or trying to beat a benchmark index. They are managing national wealth across decades. And from that perspective, the geopolitical trends driving gold demand haven't changed at all this week. De-dollarization, the slow structural shift by multiple countries to reduce their dependence on the US dollar for trade and reserves, is still happening. It actually accelerated after 2022 when the US froze Russia's dollar reserves following the invasion of Ukraine. That move sent a signal to every country that wasn't closely allied with the US. Your dollar reserves are not truly yours if Washington decides otherwise. Gold, by contrast, can't be frozen, can't be sanctioned, can't be unreserved by geopolitical decree. It's just metal. U.S. fiscal deficits are still growing. The national debt is past $35 trillion. There is no credible political path to balancing the U.S. budget. Long-term, that creates dollar debasement risk, exactly the environment where gold performs best. And now there's an active Middle East war that will likely accelerate defense spending, energy price inflation, and geopolitical realignment. If anything, these trends strengthen the long-term case for gold. J.P. Morgan's 2026 gold price target is $6,300 per ounce. Deutsche Bank sees $6,000. These forecasts were set before the Iran escalation. If you asked those analysts today whether they're revising their targets down because of this week's crash, most of them would say no, because the long-term structural thesis hasn't changed. What has changed is that gold is now $1,400 cheaper per ounce than it was 3 weeks ago. So here is the blunt question. While retail investors are panic selling their gold ETFs and hedge funds are liquidating futures positions to cover margin calls, who is accumulating physical gold at these prices? Central banks, institutional buyers, the entities with the longest time horizons and the most conviction. Are you the one providing them exit liquidity, or are you the one buying the discount? So, the question you came here for: is gold dead? No. But the version of gold that was sold to most people, the magic automatic safe haven that reliably rises in every crisis, every time, no questions asked, that version was always a simplification, at best an oversimplification, at worst a sales pitch. Gold is not a switch. It does not automatically turn on in a crisis and protect you. It is a long-term store of value that works over decades, not days. It works when you hold it through volatility, not when you buy it in panic and sell it in more panic. What happened this week is a short-term dislocation driven by 3 specific, identifiable, and largely temporary forces: dollar strength as the crisis flight to safety destination, forced institutional liquidation triggered by a geopolitical countdown clock, and interest rate fear generated by oil-driven inflation expectations. None of those 3 things changes the structural case for gold over a 5 or 10-year horizon. Central banks are still buying. U.S. debt is still growing. De-dollarization is still proceeding. Geopolitical fragmentation is still accelerating. The same forces that drove gold from $2,600 to $5,589 in 12 months are still in place. What changed this week is the price, not the fundamentals. And in investing, price and value are 2 different things. Price is what the market says something is worth today, right now, under current conditions.
Value is what something is actually worth, given its long-term characteristics and the structural forces acting on it. The $4,000 to $4,150 range is the psychological floor to watch. If gold holds there, if the physical market's support and central bank buying put a floor under it, this week's crash is a correction inside a longer bull market. A painful one, but a correction. If gold breaks below $4,000 and closes there, the conversation changes. That would be a significant technical breakdown that could invite more institutional selling and change the narrative. Watch that level closely. But here is the broader takeaway, the one that applies to every asset, not just gold. Nothing is an automatic safe haven. Nothing works in every scenario, every time. Not gold, not real estate, not the US dollar, not treasury bonds. Every asset has conditions under which it underperforms, conditions where its strengths become weaknesses. The investors who survive and compound wealth over long periods are the ones who understand why assets behave the way they do, not just the bumper sticker version of how they're supposed to behave. You now understand why gold crashed during a war. That puts you ahead of most people.